So in our last class, we have studied about the basic introduction. Today we'll talk about what are the different accounting principles. So what are the rules or code of conduct on which accounting is done or how the books are maintained. So when you talk about accounting principles, it is nothing but the code of conduct or the mode of operation, the laws on which accounting is based. Okay, so these are adopted by accountants all over the world. So these are the standard format in which accounts are maintained. Okay, so these principles can be bifurcated into two types, that is accounting concepts and the second one is accounting conventions. So accounting concepts are the basic assumptions. So these are the assumptions made overall the industry, overall in every business and all over the world. So the basic assumption on which accounting is done. Now why these concepts are necessary is because you should have an uniformity in the way that transactions are recorded. If one institution records in one format and another with another format, then comparing the data and giving logical suggestion or comparing their profits or losses will be difficult. So if everybody is playing with the same rules of the game, comparison is easy. You can talk about development, upgrading the things. If any problem, if the problem is across everybody, it can be solved better. So that's why we need a minimum code of conduct or assumptions on which the transactions can be recorded. So accounting concepts or the assumptions, we have a list of them. So we have a separate entity concept, going concern, money measurement, cost, dual aspect, period concept, matching, realization, objective evidence, and actuarial concept. Now one by one in detail, we'll study what are these assumptions. Now the very basic, the main rule on which accounting is based is the entity or the business is different from its owners, whether it is a sole proprietor, a partnership, or a joint stock company. The business is treated as a separate entity and the owner is treated as a separate entity. Now, you must be knowing the different forms of business. The sole proprietor is a form of business where there is a single owner. He takes all the decisions, he invests, the risk, profit is solely taken by him. This is the best thing for small business houses. The second type of a business is partnership. Partnership here, two or more people come together, share investments, profit, risk, and management. It has to be legally registered under Partnership Act. And the third form of business is a joint stock company. Joint stock company is a company wherein thousands of people invest small bits of money, which we call them as shares, and it becomes a big pool of huge investment, which is called as a joint stock. Means it is a company owned by many small owners. The share is divided into, the whole investment share is divided into small bits and each one will have a bit of it and it becomes a big investment. So any form of business, whether it is proprietorship, partnership or joint stock company, the business is always termed as to be separate from its owners. So even if the owner is investing, it is considered as a liability. Now what is a liability? Liability is a loan, an obligation, the thing which had to be repaid. Okay, so the separate entity concept says that the business owners are also the creditors or the person who gives finance to the business. So their account is considered separately and the business account is considered as separate. So that's the meaning of separate entity concept. The next concept here is going concern concept. So the name it will tell you it is going on means the business will stay forever whether the owner is there or not. So with it is a, you can say it is a very positive way of doing something. Okay, we are not starting anything saying that okay one day or maybe tomorrow or maybe after a few years I'm going to close it down. Okay, so we are starting it with a very positive note that whatever is started, whoever has started, that institution, that organization, that company is going to live forever. So it is going concern concept. Okay. So the lifespan of the company is perpetual or unlimited. That's the concept on which the accounting is done. And that's the reason why the whole life of the company is divided into, you can say accounting years or accounting time span. So that you can easily say this year or this quarter so much profit or loss was done. Okay, so the going concept says that the company is going to stay forever, whether the owner will leave or not, that doesn't matter. So it is perpetual, continual in nature. And third basic assumption of accounting is money measurement concept. Even yesterday I told you that here it is about business, it is about finance. We are not going to enter or record any non-financial matters. I'm not going to talk about how intelligent my MD is or what is the age of my CEO. So qualitative matters are not recorded. Only those things which can be valued in money are measured. Okay. So that is the money measurement concept. Then the next one is cost concept, also called as historical cost concept. This means that whatever you buy, big or small thing, we are going to record it on the basis of how much I spent to buy it. See, for example, I buy one property today for 20 lakh rupees and that property is going to stay there with the business. That is the property in the sense maybe a premise where the business is done. So you buy it at 20 lakhs rupees, say for example. Then after 5 years, uh, because of inflation, because of many things, the price of that property has increased to 35 lakhs. So what have to do now? Yes, anybody please answer. I have bought that property for 20 lakhs, but now it has increased, its price has increased to 35 lakhs. Now what to do next? I'm going to go to my balance sheet and scribble off 20 lakhs and write 35 lakhs. That does it make sense? Yes, please answer anybody. Okay, so you can't do this. Because of the inflation, you can't say my property is worth 35 lakhs. Why? Because I didn't pay 35 lakhs. I had bought it at 20 lakhs only. So whatever cost I have spent, only that price will be written in the books. Every now and then I can't say, okay, inflation is there, property ka rate badha, so I'm going to change my book of accounts. That will not make sense because in accounts what we do is we are showing how much money was there and how much is spent. Now unnecessary you are showing the property amount as 35 lakh. It means that you have paid 35 lakhs, but where will you show it? You have not paid so much. So all the records in the accounts are recorded based on how much money is actually spent. That is the cost concept and not the current market price, because the current market price has nothing to do with our expenses. We have not spent that much amount. The current market price will only come to picture when you are actually selling or buying. So that property, say next year you are selling, you get 40 lakhs. Okay, that time you can show 40 lakhs the property is sold and 20 lakh rupees an extra amount after depreciation. Okay, So that extra amount you can show it as capital gain. That time you can show when, so you are going to show money what is actually spent or received and not the current market price. So that is the basic assumption of the fourth assumption, that is cost concept. Now why it is done this? Because you are actually overpricing it without actually spending it. That's the reason why we are recording everything under cost. Then dual aspect concept. This means every event or every coin has two faces. Okay, there is a positive side, a negative side. Similarly, in business, any amount or any transaction has two faces. One thing is what is going out, what is coming in, means the inflow and the outflow. I purchase property, so money is going out, property is coming in. Okay, so these are the dual aspects. So what is going on? Negative is cash, positive is asset. So something is going out, something is coming in. Small to big, any small or big transactions has two faces. I paid rent. Okay, so rent is an expense. So cash is going to decrease. And rent is paid to the person who is the landlord. So every aspect is recorded based on two sides. Why? Because when you are checking, anything goes wrong. When you have two aspects of the same thing, checking, verifying the errors becomes easier. So I finished 5 concepts. Any doubts, please, you are free to ask. Otherwise, I will continue with the next assumptions. Yes, no response. Am I audible or not? Yes, somebody please answer. Are you people there?
Yes, ma'am.
Okay.
Yes, ma'am, we can hear you.
Yeah. Okay.
Yes, ma'am.
So any doubts?
No, ma'am.
No, ma'am.
Okay. And I'll continue. The next is accounting period concept. So accounting period concept is based on the second assumption. As I told you, we are considering businesses to go on forever. But you can't judge profits or losses for a continuous organization. So somewhere we have to break this lifespan into small bits, and that's what is called as accounting period concept. So accounting period concept means the life of the total life, perpetual life of the organization is being divided into financial years or quarters, so that accounting of profit losses and the financial position becomes easy. The next is matching concept. So matching concept means, as I told you, every transaction is having two aspects, one positive, one negative, or one inflow, one outflow. So that inflow, outflow should be matched. Means whatever transaction has been done, so every revenue has some expense and it should be matched to a particular year. I can't just say the profit whenever it is received, it is not that year's profit. Last year's profit, I may receive it now. Next year's expenses, I may pay this year only advance. So I need to match with the year, say the revenue and the time it should occur. So if I'm paying last year's expenses today, I have to show it as outstanding expenses that I have paid last year. This is not regarding to, this expense is not regarding to this year. If you don't do that, what will happen is, one particular year you will show more profit, one particular year you will show less profit, because you are putting last year's expenses to this year or last year's profit to this year. So that doesn't make a proper sense. So you have to match expenses and revenue to the year where they have occurred. The next is realization concept. The realization concept says that any transaction taking place, it will be considered as realized when the transaction is complete. Means it will be recorded as, maybe even if it is not got, but you have to record it then and there when it has been, the transaction is paid. So if, for example, you have sold something, so when the seller gets the delivery of the goods, then you can record it as a transaction is complete. That realization means you are going to get the revenue. Before that, it is not considered as realized. Then objective evidence concept means every transaction should have a documentary evidence. It may be a bill, it may be an invoice, it may be a receipt. So whatever transactions, big or small, you should have a note attached to it to show that whatever money is spent is not fraudulent. It is spent in a genuine way for the betterment of the business. That's why whenever say you're working somewhere and the accountant, you have been sent to some particular project, then the accountant asks you the details. He asks about every small ticket, every small bill. Why? Because it is very much necessary to show them that the business funds are not being misutilized. The last one is accrual concept. So accrual concept is an I can say added concept of matching. Means whenever the expenses or revenue are accrued, even if they are not received, we have to write it in the books showing it is prepaid or outstanding or unpaid. So even if you don't pay this year, you are going to show it as unpaid, amount outstanding, or prepaid. So accrued concept is all about an extension of matching concept where you are recording everything in advance, even though you don't get the actual, don't give the actual cash. Okay, so these are the different accounting concepts or different assumptions on which accounting is being done. Next is accounting conventions. So what is convention? Convention is nothing but a tradition or a culture or a habit. Okay. Why I am doing this? Because it is being done since ages. So convention means the habits, traditions or culture. So same habits, some habits are also there in accounting or bookkeeping. So these four habits include conservatism, full disclosure, consistency, and materiality. Now, conservatism means we are playing cautiously. Now, we have a few commerce students here. Yes, how many of you have studied commerce?
Mom, I have studied commerce.
Okay, one.
Me too.
Two.
Me.
Three.
It's me, ma'am.
Four. Okay. So maybe half the class is having commerce knowledge, right? So we have a concept called as bad debts, provision for bad debts, right? Yes. What is this provision for bad debts? Why is it done? Yes, anybody can answer. No? No idea?
Pay off debt.
Pay off debt. No, but why we are doing provision for bad debts? Let it be, madam. We have done it monotonously. It was given a standard that 10% deduction. We do it, right? Yes, we do most of the things mechanically nowadays instead of understanding why we are doing it. Yes, any idea why these provisions are done? Yes, no one. This is bad. You have finished your BCom. Okay, anyway, I'll tell you. So this provision, what is this bad debts? Or debts means you have sold something or you have given some service and the other person has to pay you. Okay, he has not paid you at the time of the transactions. You have given him credit, so he'll pay later, he or she, whatever it is. So now like this, there will be many customers who have not paid, and maybe how trustworthy the person is, maybe something goes wrong, some people don't pay. Okay, so it is a precautionary arrangement for any unforeseen future losses. So maybe 1% of your total debtors are not going to pay. You just assume to be on the safer side. So it is like having at home you have a first aid kit or a medicine kit. That basic crocin is there, one paracetamol, one painkiller, some Bernol, right? So it is a precaution. Kuch hua to use hoga, right? So this precautionary arrangement for any future losses or future problems, some amount is kept aside. This is called as conservatism principle convention. Means I'm going to provide for all possible losses, but I'm not going to anticipate any revenue beforehand. Okay, next year I'm going to get something. I can't show it in the book, but loss may happen that I will definitely show in my accounts, in my balance sheet. So that is called as conservatism principle. So it is like playing safe, being cautious, being ready with all, you can say safety zones, safety issues. So that is called as conservatism convention. Then the next is full disclosure. This means that every small big details of transaction, right from 1 rupee to the maximum amount, everything will be fully disclosed in the books of account. No hiding will be there. There will be no fraud. There will be no hide and seek game. Every detail of the company as financial transactions will be disclosed so that the owners are not kept in dark. Okay. And the third habit or tradition here is consistency. Consistency convention means continuously every year I am not going to change the rules. I'm not going to change the way I maintain my accounts. Okay. Every year there will be same types of assumptions, same types of standards. Every now and then if I change the format of accounting, I change the way the things are credited or debited, then there will be a lot of confusion. Then you can't compare, and there will be a mismatch between the same organization between different years. So you have to follow the same rules, same principles over the years so that you can compare your present standing with yesterday's. Okay, so it is consistency means doing, it's not like if example, if you are interested in cricket or sports, you can't say one day 0 पे out हो गया, next day 100, third day 30. No, this is not a consistent player. So we want a person whom we can rely upon. Okay, average 50-60 chalta hai daily, not an issue. We don't want to have huge ups and downs. Okay, one fine morning you feel okay, this raw is not good, I'm changing it. You can't do that. You have to be very consistent. Same things. Okay, there is a you can say over a period of time you can change the things, but it should be very slowly. The change should be upwards. One day something, second day something else will not be entertained. So that is the meaning of consistency principle. Then the last is materiality. Materiality means everything which is of material importance, which is of financial terms, those things will be recorded. Anything which is not important, it is waste of time. On such things, I'm not going to spend any time and energy. So, which are legible, which are important, which are huge, and which will make a difference, only those things will matter and those things will be recorded. So, these are the different principles, concepts, conventions on which accounting is based on. Yes. Any doubts?
No, ma'am.
No? Clear? Everybody?
Yes, ma'am.
I am not having full attendance up to now. Only 7 of you are attending daily. Where are the others? Is this the same attendance in every class or only in my class?
Almost every class, ma'am.
Yes, some faces I have not seen only.